Let's move right on then. Equitas Small Finance Bank in the spotlight. Let's understand a little bit more about the quarterly performance. There's been a sharp margin compression. Is there going to be a recovery or not? PN Vasudevan, the Managing Director and CEO Equitas Small Finance Bank, joins in. And I'm going to get straight to it, Mr. Vasudevan. Talk about the margins because earlier you had guided for 8.5% for FY24 for the full year, but it seems like you are seeing some pressure. What is the outlook on your margin guidance? Are you going to be altering it?
Good morning. Our interest cost, if you see in the first quarter was 6.94%, and it was moved to 7.21 in the second quarter. And we had guided that the interest cost should end up for the year at around 7.5% by end of the year. So you can see that the interest cost increase over the next 6 months is expected to be moderate. Largely because most of the old deposits have got repriced now, and we are left with only a small part of the old deposit, which will get repriced at the higher rate of today. Correspondingly, over the last few months, we have also increased the lending rate on some of our loan products. And the benefit of that, we expect to see over the second half of the year. Because it takes time for the increased rates to actually start impacting from an income perspective. A combination of these two, is what we expect that the NIM, which is at 8.45% for the second quarter, the exit NIMs for the year could be around 8.25 to 8.3. However, for the full year on a full year averages basis, we still expect the NIMs to be in the range of around 8.5.
Okay, fair enough. So that's the outlook when it comes to your overall margin. What's the sense as well when it comes to some of the other parameters in terms of your overall growth guidance? What really has been aiding the growth so far and your sense on whether or not this is likely to sustain? You are well capitalized. So does that mean that your growth guidance as well remains the same?
Yeah, on the growth part of it, as we have been informing before also, we are largely serving the underserved or unserved segments of the population, where there's a large amount of unmet demand for credit. So typically speaking, the demand from the market is generally never the issue for us from a lending perspective. And we are also well capitalized. We are at capital adequacy of in excess of 21%. So we expect that we should continue to be able to grow in the region of 25 to 30% over the next few years.
Give us a sense on, Mr. Vasudevan, where the unsecured book is like and what's the kind of exposure. Are you calibrating or going cautious on any on growth in any of your particular segments that you have exposure to?
In terms of unsecured, we are not into the personal loan market today. Our unsecured book is only the microfinance that we have been doing from 2007. And microfinance is contributing about 19% of the total advances as on date. We have always been saying that, we will continue to pare down the microfinance over a period of time. And, when we became a bank 7 years back, microfinance was as high as 53%. Over the last 7 years, it's actually come down to about 19% and replaced by all other loans, which are all secured, except microfinance. All other book is secured book. So we don't particularly see any concern in our unsecured book, which is our microfinance. The microfinance industry, whenever there is an extra event or a market event or an external event, microfinance tends to get under some stress. But if there is no specific external event, microfinance typically tends to perform very well. And so last 1 year, actually, microfinance has been doing extremely well. And so we are really not having any concern from our unsecured book, which is principally the microfinance.
On the deposit side, though, Mr. Vasudevan, you've done pretty well. Is it just higher rates offered to customers or something else that you're doing differently?
You see, our interest rates on deposit definitely is higher than the large banks. But I'm just cutting back about a year and a half back to May 2022. The difference between our peak deposit rate and that of the large banks' peak deposit rate was around 2%. And today we have reduced that to about 1.5%. So nearly 50 basis points we have reduce the difference between our peak rate and that of the large banks. So over time, we have been trying to consciously reduce our interest rate on deposits. However, there is still that small increase compared to the large banks. And that's definitely an attraction from a depositor perspective, especially senior citizens. And almost half of our deposits, 45% of our deposits come from senior citizens, for whom that 1% plus does make a lot of difference. And we have been seeing a very strong traction in our retail TD, especially over the last 6 months. Our retail TD has grown very sharply. And second quarter, we saw an increase of nearly 40% on our deposits.
All right, fair enough. I also wanted to get in a sense as to what the outlook is when it comes to your credit costs, because those are benign. Are there any early signs of pressure that you're seeing or any buffers that you would look to build in at this point?
So that's a good story. Credit cost continues to be a good story for Equitas. Historically, we have been in business from 2007, so we have nearly a 15-year-old company come bank. And except during demonetization and COVID, which are external event stress created from external events, we have actually never seen a credit pressure on the company ever. So our underwriting norms, our method of sourcing the customers, we don't source through DSS at all. It's almost all of the business are sourced directly by our own staff. So the sourcing methods, the underwriting norms have been good enough, touch wood, that I believe that our portfolio quality should remain strong through, minus huge pressure created from external events. So long as we don't get that kind of stuff, I believe that we should continue to have very comfortable credit costs. It used to be in the range of 1 to 1.1% pre-COVID, and I think it should settle around that 1% to slightly lower than 1% going forward. Today it's about 0.8%, so we are maybe it may go up by about 10 basis points over the next 1 to 2 years. But I think we are more or less where we are likely to be on a sustainable basis.
All right, good to know. And a quick word on your outlook on net interest margins. Is there any pressure? Do you think that you will maintain your margins?
NIMs, I had mentioned that slightly earlier. As I said, we expect for the full year, we expect to have a NIM, the full year average to be around that 8.5% level, while the exit NIM could be towards that 8.25 to 8.3.
About that, yes, you had reiterated that in your first answer itself, 8.5%, and you will be looking to maintain that. Okay, good to have you on board. Thank you so much for taking time out and joining in.